Getting ready. You are in the right place at the right time. Getting ready for the show, the big market calls of 2022. Ready, set, go. Hey, I'm Mitch Goldberg. Thank you so much for joining me today. You're watching my live stream, which I host every Monday through Thursday at 4:30. It's your post-market show about the action in the stock market. What happened, why it happened, where do we go next? We talk about financial planning, personal finance. We talk about things that could help you take control of your money. That's why I call this show Be the Boss of Your Money. So thank you very much for joining me. We're talking about the big market calls of 2022. That's right. It's that time of year. Lots of headlines coming out, big upside in 2022, big downside in 2022, and everything is just, everyone is all over the place with all kinds of predictions. So should you even pay attention to this? Should you know about them? Some of the headlines and predictions are downright scary, and some of them are, make you think that I don't have enough invested. And we're all over the place. So we need to explore this. We need to moderate what we think in terms of getting overly excited or overly depressed with the headlines. That's what the show is all about. We're going to go through the headlines and the big market calls of the biggest strategists, and we're going to do that now. So check us out. We're going to roll the intro, and while you're watching this, if you have any questions, please ask me in the comments. I love hearing from you. Words of wisdom are always appreciated, and I will see you in a moment on the other side of the intro. Thank you very much. We're just getting started. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. I do this every Monday through Thursday at 4:30, and I'm so glad that you chose to spend some time with me. We're going to talk about today's market action. It was a pretty good down day on Wall Street after hitting record highs at the end of last week. That's right. With all the negative news and everything bad going on in the world, Russia and Ukraine and Russia and the West, China, inflation, just so much bad news. The spec wreck, we actually hit a record high in the S&P 500 just this past Friday. Today's Monday, and we gave a little bit back, a little bit more than people are comfortable with. But I still think we're in these aftershocks. If you recall, the Friday after Thanksgiving, the Dow dropped 905 points. And that has been followed up for about a week and a half, 2 weeks with some really, some really major ups and downs. One day the market was up like 500 on the Dow, and it wound up closing down over 400, almost 1,000-point swing on the day. I think we're still feeling the aftershocks of when the Federal Reserve, specifically Jerome Powell, the chairman of the Federal Reserve Bank of the United States, we're feeling the aftershocks still when after he recently said that it's time to retire the word transitory when describing inflation. It's here, it's stickier, it's higher than they expected, and now they have to maybe tighten a little bit more. The fear was always that the Fed gets behind the inflation curve and has to react very quickly. It has to catch up to inflation, and the reason that's such a problem is because it means the Fed has to, not maybe super gradually, but more aggressively, it has to raise interest rates and squash inflation, and it's got to do it quickly. It just sets up the kind of market dislocations, adjusting to higher interest rates quickly without giving investors much of a chance to figure out what to do next. That causes a lot of volatility. And usually when I say volatility, I mean downside. And that's the big worry. Now, right now, the belief is that the Fed will just very gradually raise interest rates. The expectation is that the first rate hike is May or June of next year. We'll get two or three rate hikes in 2022, maybe three or four in 2023. That's the expectation. We could get more. And that is a worry. I think that's the biggest worry in the overall uh, financial markets, okay? That the Fed is so far behind the curveball. So I'm sorry, that the Fed is so far behind the curve that it has to rush to pull back on stimulus and tighten credit conditions, which would then hurt the economy because borrowing costs would go up. It would be harder to borrow money. Our whole economy runs on borrowed money leverage. That would make it harder for businesses to grow. It would make it harder for businesses that are in desperate need for cash to get that cash. That would cause bankruptcies, stocks going down, bear markets, pandemonium, and a complete obliteration of the stock market, leaving investors with nothing but burnt out, cindered, scarred, charred paper. I don't think it's going to be that bad, but you never know. And that is something that investors are a little bit worried about. So as a result, investors are taking some money off the table. Um, and why not? It's been a good, 2019 to 2020 was a good year. This year was a pretty good year. People, I think, are still overloaded in stocks, and every time the stock market recovers from a bad couple of weeks, it reinforces buy the dip. Um, it keeps people brave, and I don't think people have been shocked and into a state of awareness about risk. Now, don't get me wrong, I'm not like some masochist where I want everybody to get shocked into some state of higher risk. That's not what I'm looking for, not what I'm trying to do. But you have to understand. Uh, from my point of view, I'm giving you this. That's what the show's about. From my point of view, it's my perspectives. I definitely want to hear from you, and I want to hear your perspectives. But my perspective is that every client is different. Every account is different. All of you are different. So should all of you be investing the same? Excuse me. That's that's what I'm trying to, I guess, point out. So not every, is it time for some people to pull back? Yes. The biggest problem people have when they pull back on risk on stocks is, what do I do with my money? Because nothing that pays a good yield is safe, and nothing safe pays a good yield. And people, investors are just not satisfied with keeping money in cash because it doesn't pay anything. And now with inflation at 6.8%, your $100,000 would lose $6,800 a year in a year uh, just by sitting in cash. So therefore, investors are feeling compelled to stay in stocks in spite of what many feel the risk level, the risk premium for stocks has gone up. If the Fed raises rates, it's behind the curveball in inflation. The Fed takes the punch bowl away. That's what we used to describe the Fed inducing a bear market in order to slow the economy down, in order to slow down inflation. That's what happens. You can't have it both ways. Imagine if the Federal Reserve never had to worry about the stock market. Imagine if the Federal Reserve just made its decisions based on what's best for the economy. And now, our economy is very advanced, it's very complex. You really can't separate the markets, financial markets, from the economy because they're hand in glove. They are needed. They're so strongly connected that if you hurt one, you hurt the other. And if one gets hurt, it drags the other one down with it. So the Fed is in a box, or at least a lot of people feel that the Federal Reserve is in a box. It can't pull back on stimulus, it can't tighten, it can't raise rates because it'll hurt the market. And investors are aware of that and will push the Fed into doing what the market wants. Investors will push the Fed. On the other hand, the Fed has a responsibility that are twofold: maximize employment while maximizing price control, price steadiness. That means fighting inflation or deflation while maximizing employment. And those are like so contradictory. And we're the only, by the way, we have the only central bank in the world who has that dual mandate. Most central banks, all central banks except for ours, actually, it's all about price stability, not a matter of what's good for just employment. And we have a Fed that has the jury is not really out anymore. The Fed's gone way overboard in terms of stimulating the economy with low unemployment and a high inflation rate. We've never had interest rates this low. Now we've had a lot of things that you could use the words we've never had this before. And that goes for so many things because 2020 was not a normal year. 2021 was not a normal year. And we don't know what 2022 is going to bring. And I don't even know if there's anything, I don't even know if there's such a thing as a normal year. What is a normal year to you? A normal year is 6% unemployment. Is it 4% unemployment rate? Is it low interest rates, high interest rates? One of the things that's keeping inflation down is private equity, and companies have the ability to raise money. And there's so much money that wants to get invested that investors are willing to accept higher risk and lower returns, when it's usually the opposite. A lot of divergences here, and it's one of the reasons why I don't get bored with my career, because the stuff that's going on now was not the stuff that was going on when I started in my career. The things that are going on now are amazingly interesting to me. Even when the market has a down period, I still find it fascinating and incredibly interesting. And it just captivates me. It holds my attention, the way the stock market and the real world interact, the interplay between the economy and markets and how it works globally, and how decisions of central bankers, politicians, policymakers, how all of those could work. And it's exciting to me. And I like to predict, we're going to do this policy or that policy. What's going to happen? Anyway, market gives some back. Let's take a look at how things did today. Okay. Let me get rid of the icons, the social icons. Okay, that's better. So the Dow was down 320, not quite 1%. NASDAQ was down over 1%, definitely gets my attention. S&P was down 43 points, down almost 1%. Gold was up a tiny bit. Gold just stays in the 1700s. Gold does not show and has not shown that there are any real worries about inflation in spite of inflation. And that is another very strange thing. In the past, throughout my entire career, and it's over 30 years, gold would be soaring and to scream inflation, but it doesn't do anything. Oil can't get out of its own way anymore. Okay. The U.S. 10-year Treasury the yield was down today. Why is this yield down when you'd expect it to be much higher? If we're having real sticky inflation and the economy is stronger, why is and the Federal Reserve is not the big buyer in the market anymore with 100 with 80 $80 billion of treasuries that it buys every month at 40 billion of mortgage bonds. But if the Fed is going from 80 billion to 60 billion to 20 billion to zero, why aren't why isn't the 10-year yield going up instead of down? VIX is up a little bit, slightly over 20. That's, considering the volatility we've had, and the VIX was almost 40 about a week ago. Things are really very calm. One reason I think things are calm is, yeah, it's the end of the year. Nobody really wants to make any major moves, but there's something else that we'll talk about. And the Russ 2K, the small caps, we're down 1.4%. Okay. Let's take a quick look at crypto, because I'm surprised this didn't get more attention in the media. But anybody notice that Bitcoin was down 7.5% today, and basically crypto across the board has gotten smashed? Ethereum down 10%. Well under 4,000. These are big moves. These are pretty significant. Okay, Bitcoin went out today at 46,000. Wasn't it supposed to be above 50 by now? So these are pretty big moves. And Litecoin is down 10%. Uh, Doge is down to 16 cents. I remember when Elon Musk touted it, and it went to over 70 cents. And I made a whole video about that. I was pissed. Like, you don't do that when you have that kind of audience and you're considered one of the most sophisticated, smartest investors in the world. If you tout something, people who don't have the financial wherewithal nor sophistication will follow you. And these people got burnt by a mega billionaire, by the wealthiest person in the world, or top two or three. I really, you have to be careful when you have that kind of responsibility. It's like the complete opposite of Warren Buffett. And I think when you have a mouthpiece and a soapbox that everybody hears you on, you just have to be careful. But crypto got crunched. This is a really bad day for crypto. It just didn't seem to make the headlines. But what's really happening right now is this: things are quiet ahead of the Fed meeting, which starts tomorrow. It's a 2-day meeting, tomorrow the 14th, Wednesday, December 15th, around 2:15. We're going to find out what the Fed has said, what's in their statement. And the expectations is they're going to cut their quantitative easing faster than than originally stated. We're all expecting that, by the way. And they'll probably say we still see a very slow, considered glide path to rising rates. And the next Fed meeting is in January 22nd, I think it is the next Fed meeting. But we are looking for some hints about what the Fed thinks about raising rates. And that's why you're seeing this market not be able to I think it's where you're seeing things steady at the moment, because 300 points on the Dow is not that big of a deal. People want to see what the Fed is going to do. That's all. So let's take a look at the original thing today. This was the thumbnail today. It's time for the battle of the 2022 market calls. Okay. So let's take a look. Like, for example, Oppenheimer. I'm going to pop this up on the screen. Okay. Oppenheimer sees a 13% S&P 500 gain next year on a resilient economy and strong earnings. Okay. Strong earnings. I could see that. I mean, that's kind of the common call, is more upside because we are still reopening. There's enough inflation for commodities producers to make more money. Demand instruction hasn't happened yet, so I could definitely see that happening. And Keith is out there. Cautiously optimistic will be overused next year. So true, Keith. It's like overused. We're cautiously optimistic. This way, if the market goes up, well, we told you we're optimistic. The market goes down. We told you we're cautious. And you know what? I think that's okay because you don't know. But the smart thing is to bet on an up year every year because most years the stock market is up, and over time, by making major portfolio adjustments based on headlines and annual market calls, is a way to destroy your wealth. And I really want to implore you on that. You see, I don't, as a financial advisor, I don't manage just one big portfolio that everybody's in. I manage lots of portfolios because I have lots of clients. Now, some of my clients have more than one account with me. Many of my clients, um, many of my clients are in modeled portfolios, pie chart type portfolios that I put together using some using index funds, some using stocks, ETFs, that sort of thing. But for the most part, they're different, and everybody's needs are different. So I don't just say like next year I'm going to only favor XY stocks, or I'm going to really look to jump on more, big tech stocks like Amazon and Google. It's different for every client. So I don't have like this Uber call. And it doesn't really matter to me if somebody says the S&P 500 is going up or down. Actually, as a matter of fact, my life and the lives of my clients are not dependent whatsoever on whether or not the S&P 500 goes up or down next year. You see, the money that we need, that anyone needs, is already set aside in cash. We're not all cash. So if the market keeps going up, you would participate in the upside according to your risk tolerance, your time horizon, your financial goals, which would determine how much cash on the sideline you need for a future financial need. And maybe, when I say I favor small caps or international, might not be, it doesn't mean for everybody, but maybe instead of a client rebalancing their whole portfolio, maybe we'll just add a little bit more to small cap instead of rebalancing everything. And we could be more tactical about the portfolio management. Okay. Tactical is, I think, a word you're going to hear a lot, as well as the words cautiously optimistic. So these are some of the things that we take a look at. So let's see. I want to show you a LinkedIn post that, look, you ever put something up on social media and you think it's like a killer post, it makes so much sense, and you're like, this is going to be so hot, it's such a good idea, it's so well written, I'm looking for it, I'm scrolling looking for it, which is why I'm looking over there at my other screen. But yeah, you know what, I just moved the screen here so at least I'm not looking that far away. But you ever post something that you think is so good and then you're like, wow, it didn't really get a lot of play, didn't get a lot of hits, and you have to wonder a little bit about that. So I posted something that I thought was a couple of things that I want to share with you. All right. One of them is about conflicting headlines, and I'm really surprised it's taking me this long to find it. Okay, so I'm going to go to my profile. I'm going to, what I'm going to do? I'm going to put you on my profile. Okay. This is me now. Th- th- this is me speaking right now. Okay, a bunch of you are watching, and I really appreciate it. Well, let's go to activity. There I am again. Let's go to posts. Let me make this a little bigger. And I know what you're thinking, Mitch, maybe you could have this lined up before you before you go live. Okay, this is what I want to show you. Okay, this is exactly what I want to show you. All right, here it is. Wharton's Jeremy Siegel says Fed rate hikes will be good for the stock market next year. Maybe not for 2023, but we're not talking about 2023 now. We're talking about just next year. Fed rate hikes equals good for markets next year. Now, Dan Niles, who is a very, very highly regarded stock market caller and uh, technology analyst, super highly regarded. Dan Niles, I'm sure many of you have heard of him. He says S&P 500 could drop 20% as the Fed hikes rates. So Fed rate hikes is bad. The other guy said it's good. These, I pointed this, I don't know if you can see it on your screen, but these came out Friday. The headlines came out less than 2 hours apart. Okay. And then I wrote investors, I added my title, investors be like, with that weird, ugly face. All right. And I put that in there to make a point that this could confuse people. So I think the text, what I wrote, makes a lot of sense. I'll put you back up here. Okay. It's the battle of the headlines. Pictured below are conflicting headlines about the impact of Federal Reserve rate hikes on the stock market less than 2 hours apart on the same major media website. Okay. Website is my favorite website, and it's a great website at CNBC. And I wrote, but that's okay. It's about giving you differing opinions so you can make an informed decision for yourself. It should get you to think about how you'd feel if you sold stocks now and missed more upside, or if you don't sell now and think about how you'd feel if the value of your investments plunged. And I should mention that there's nothing like good headline copy to keep you glued to the website, too. And I wrote, but for us regular people, so you have all the emojis of regular people, men and women as well. But for us regular people who are investing for our retirement and to help fund our kids' college education, these headlines you see in the pic mean nothing other than the fact that you may enjoy this stuff like me, okay, like I do. Our investment decisions should be based on our own personal finance, our own personal finance situation. You have many years ahead of you until you retire or receive your first tuition bill. Stick to investing in dollar cost averaging and don't stop. You have a few years until you retire or until you're expecting your first tuition bill. Sell enough stock market investments now to make sure you're preserving the money needed. The real truth bomb is there aren't any headlines about those two questions because it would be boring. So we've got a couple of Z's up there, and it would end your personal need to keep checking for new headlines. Don't let eye-catching headlines throw you off a sound financial strategy. And that's just to give you an idea of the kind of content that I post. I don't want to just say don't make your decisions based on fast-moving or exciting or scary headlines. I tell a little story, and it sinks in better that way. Let's take a look at some famous market soothsayers. Okay. Jim O'Neill, Dan Niles, Guy Spear, and 7 other market strategists. We're not going to go through every single one of them, but my favorite person on the list is Jim O'Neill, British fellow, Goldman Sachs executive, one of their top guys. He was always on CNBC. And the thing I really like about Jim O'Neill is he always has a look about him that says, I went out last night drinking hard. Like he's never has a clean shave, kind of like me. He's always wearing a suit that's like buttoned down to like the middle of his stomach, open shirt. And he just looks like he just got home from a soiree. He could just as easily take a nap as he could play squash. And he just talks into the camera like just. So the guy just, I think he's pretty cool for a finance guy. What can I say? Oh, Mitch, you have a man crush. No. But he says, wasn't so clear to me what he said. Let's see if I could get this in here. What Jim O'Neill said, I'd have to go through all these people now and make you go through okay, look, I'm not going to go through every little thing. They all said the same things. Watch out for the Fed, but that's the only thing that they seem to have in common. But on a small, medium, and large basis, it's either we're going to be down, we're going to be flat, we're going to be up. Easy enough, right? But they all have something similar to say is they're all concerned about rising interest rates. Some feel that profit margins and profits will be so strong that that will help the stock market go up. And some say there's no amount of profits that could overtake the gravitational pull of the Fed jacking up interest rates because it fell behind the inflation curve. But they're all over. The calls are all over, from very bearish to very bullish to very moderate. And what I'm telling you is it doesn't really matter. You're going to invest based on your needs, your goals, your time horizon. You're going to continue to stay diversified, which, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So nothing really changes. Mark Mobius says the increasing pace of digitization means that in order to survive, all companies will need to upgrade the use of technology to improve efficiency and profitability, while emphasizing ESG plus C. I just made a post about ESG, posted it today, by the way. It is important to note that we have found ESG to be critical to reducing risk. We found that all sectors. So he's very into ESG and says ESG is a winner. Dan Niles says, who we spoke about before, inflation matters, removal of stimulus matters. In 2020, the year the pandemic started, the S&P was up 16%. So far it's up about 25% this year. And despite the pandemic continuing, the annual historical price return of the S&P 500 is 6% since inception. So either the pandemic is 3 times better for the world than a normal environment, or something else is driving returns. After 3.2 trillion of stimulus over the last few years, and another 4.5 trillion in the last year and a half. Okay, so just about 8 trillion. As a result, valuations are record highs, are super high, and that I think is like that lays out the bearish side, that valuations are super high. The bullish side is the biggest companies still have great numbers, are still the companies we all need to rely on, that should keep growing, like Facebook and Google and Amazon, et cetera. And those will keep powering ahead regardless of what the rest of the market does. I think that commodities have been underinvested, and as a result, supplies are tight. So commodities could continue to do well. Small cap stocks have gotten down to valuations that are low historically, and they've lagged. So I think there's a catch-up trade for those, so money could go into those. I still think that the spec rec, like the SPACs, the meme stocks, the stocks that tie themselves to crypto, I still think those are going to continue to be a source of cash for other investments. And I think international investing for U.S. investors has gotten a lot of, has been ignored. So I think there's opportunity over there. It doesn't mean that I'm going to do these things for every single client I have. It depends on their needs. I mean, some clients are just really not meant for the stock market, and some clients are very well meant for the stock market. But it's more of a personal finance / age factor than anything else. So that's it. I hope this helps you to moderate the fear or excitement that the headlines are generating now. Everybody wants to get their market call in before the end of the year. Nobody is going to get any attention paid to their market call if they just come out and say, I really don't have a crystal ball. We're just going to keep investing based on our own personal finance needs. We're going to keep dollar cost averaging. We're going to watch investment expenses. We're going to remain diversified, and we're just going to keep going with that. If that was the market call for anybody made, nobody would pay attention to it. But that is the market call that I believe is most appropriate for you and I, for us regular, normal investors who are not hedge funds. All right. Thank you so much for watching. I don't expect to be around tomorrow. I might do a live stream either tomorrow late evening or early afternoon. It depends on if anything crazy happens in the market, but I don't think I'll be around here tomorrow. I've got some things to do, some places to be tomorrow at around 4:30. So we may just wait till Wednesday to see each other. So I want to wish you well. I hope you had a great weekend and talk to you soon. Thank you very much for joining me.